All right, if I could get everyone's attention. My name is Pat McCann. I'm a research analyst here with Noble Capital Markets. We have a BCP investment today. We're going to do this in sort of an informal fireside chat format. So I'll be going through some questions. If you have questions, feel free to raise your hand. And if not, we'll certainly be taking more questions at the end. So with that, Brandon, I guess we can go ahead and get started. Could you just start by giving a high-level overview of BCIC?
Sure. So first of all, thank you all for coming today, and thank you, Noble, for hosting this event. As a small cap, sub $250 million market cap company, events like this are incredibly important for us and a fantastic opportunity to engage with you guys. So thank you so much for this. BCP Investment Corporation is a NASDAQ-listed business development company. It IPO'd in 2006. BC Partners, which is the advisor to the fund, or an affiliate of BC Partners, which advises the fund, took over managing the BDC in 2019. So for those that may be less familiar with what a BDC is, a business development company was created by Congress in 1980. It's a registered investment company under the Investment Company Act of 1940. So we're subject to all of the 40 Act regulations. However, while they've relaxed some of the leverage requirements and things like that to accommodate our portfolio, by virtue of Congress's mandate, we are required to invest 70% of our portfolio in what are called eligible portfolio companies, which are small and mid-size U.S. private companies and microcap companies, sub 250 million, to the extent we wanted to finance a public company, albeit we don't have any public exposure in our portfolio today. So BCP Investment Corporation is a direct lender. We target first lien core middle market loans to companies in what we believe are resilient industries that have non-cyclical cash flows that generate between 15 and 35 million of EBITDA. Our stated mandate's 10 to 50, but really our sweet spot is that 15 to 35, and call it 25 is probably a run-of-the-mill core middle market portfolio company that we would look to finance. Our target leverage ratio is 1.3 to 1.4 times. Our regulatory cap is 2 to 1, so we're well underneath the 2 times leverage that the 40 Act requires us to stay beneath. And we're NASDAQ listed, ticker symbol BCIC.
Excellent. And could you give a little overview of BC Partners and the connection there and the synergies therein?
Absolutely. So BC Partners is a almost 40-year-old storied private equity firm with about 44 billion in assets under management globally. So their presence is predominantly in Europe, and certainly their history sits there. However, in the early 2000s, leadership identified the attractive U.S. markets for private equity investments at the time and wanted to make a push into the U.S. markets, particularly on the LBO side. So they moved their leadership to send a strong message to their institutional investors in the early 2000s, which proved to be successful. Leadership still sits in New York today. Fast forward 2017, leadership of BC Partners identified the opportunity in private credit as well as real estate early. They wanted to expand and differentiate their platform by having both of those two verticals, and they launched those two asset classes. The credit platform today has grown from 0 to 9 billion from 2017 at inception through 9/30/25. So we've had a period of tremendous growth under the leadership of our CEO, Ted Goldthorpe, who was previously at Apollo and president of Apollo's BDC, AANV, which is now MidCap. And prior to that was a managing director at Goldman Sachs and their special situations group.
Excellent. And as I understand it, you guys have acquired and fixed up maybe what you would call other broken BDCs. Could you talk a little bit about that strategy and your niche there?
Absolutely. What we've done with BCP Investment Corporation is incredibly unique. We've what we refer to as a BDC roll-up strategy. There were a number of dormant hung BDCs, in the late teens, early 2020s that were ripe for a strategic combination. We identified that early, underwrote the portfolios, and found that generally NAV was strong. NAV reflected the true performance of the portfolio. So if we underwrite an acquisition at NAV, which has potentially embedded losses already reflected in it, if the BDC was quote unquote broken or struggling, we could generate real value and grow in an accretive manner without having to issue equity below net asset value, diluting our public shareholders. So since then, we've started with an inorganic transaction. We took over the legacy KCAP BDC, externalized it, and it became Portman Ridge. Portman Ridge then acquired Ojai in late 2019, within the first year of taking over under our stewardship. Then we acquired Garrison Capital in 2020 and Harvest Capital in 2021. So in 2021, we also became the investment advisor to what was called Logan Ridge Finance Corporation, but previously under the former manager was Capitala's BDC, Capitala Investment Corp. So at the time, we had done enough work on Portman Ridge, post the 3 transactions we had just completed at that time, that it didn't make sense to combine Logan Ridge into Portman Ridge right away. We wanted to do some work on the portfolio, rotate out of some of the legacy equity positions that we had inherited from the former manager, and redeploy that capital into interest-earning assets originated by the BC Partners Credit platform. So it took us, when we took over the equity portfolio was north of 30% of the book. We shepherded the portfolio through accretive exits, got that down to about 10%, and fast forward to July this year, we combined those 2 companies and just reported our first quarter earnings for the combined Portman Ridge, which we, as part of the transaction, rebranded as BCP Investment Corporation.
Excellent. And then from an overall perspective, what does the portfolio look like today and the yield profile and so forth?
Yeah, so the portfolio today is predominantly first lien, about 72%. And when you factor in our joint venture, it's just north of 80%. And I say our joint venture, that is an entirely first lien book that sits in the joint venture portfolio. So that's why I include it with our first lien portfolio. We are about 1.4 times levered. We're about 50% secured and unsecured on our debt capital structure. The portfolio generates about a 9.5% operating ROE, or NII over NAV. And year to date, we've generated about an 8.2% return on equity relative to our 9/30 net asset value.
Excellent. Could you also talk a little bit about the funding structure, the secured notes? I believe you have some newly issued notes and some redemption of previous notes. Could you give a little overview of that?
Sure. So we're about 50% secured and unsecured. Ideally, I think we'll probably migrate to probably a 60% secured going forward. And that's just a function of the cost of capital, as well as what the credit rating agencies require. They want to see at least 30 to 40% unsecured. Today, and for the last few years, we've been heavier on the unsecured side because unsecured debt was so cheap in 2021 when we put it on. However, those liabilities rolled off. The market is a little bit sort of a mean reversion back on pricing where unsecured, there's a limit to the amount the portfolio can handle and generate an attractive yield. So I would anticipate going forward, our funding mix will probably be about 60-40 secured and unsecured. On the issuance we just did, we did $75 million 5-year notes at 7 3/4, and then we did a $35 million 3-year note at 7.5%. So the idea there was, frankly, to avoid what the former presenter highlighted that he experienced. He had a $300 million maturity coming due all at once. We wanted to term out our balance sheet, which is why we broke down the $108 million we refinanced into a 3-year, 5-year term, also to take advantage of the dynamics in the market at the time relative to 3-year, 5-year maturity pricing.
Before I ask more questions, just want to make sure if anyone had any questions they wanted to jump in with, you're more than welcome to. But I was wondering if you could talk a little bit also about the modified Dutch auction as well.
Sure. So taking a step back, I think, what differentiates BCP Investment Corporation is its inorganic growth strategy. We are one of the only BDCs that has found a way to grow our book value inorganically, which in an accretive manner to shareholders without dilution. So I also think our trading dynamics are unique. We're smaller than most of our peers. However, we have the breadth of a $9 billion credit platform backing the BCP investment portfolio. So when we originate investments, we can speak for much larger pools of capital. The average deal size is 70 to 100 million that we do on the platform, and then we allocate it across our vehicles. So the institutional support that the broader credit platform provides is incredibly unique for BCP shareholders. And there is no other BDC of our size that has that sort of institutional backing. So right now, we're trading at about 76% of NAV, and we're generating about a 14.5% yield on NAV. I think those dynamics make for a very unique and attractive investment opportunity for shareholders today. I also want to highlight we have an extensive history of doing shareholder-friendly items like this tender offer program we recently announced, where we committed to repurchasing up to 20% of our shares outstanding to the extent we continue to trade below 80% of net asset value over the course of the next 2 years. Now, those purchases could be in the form of a tender offer like the one we just announced for $7.5 million, daily buybacks, management purchases, which wouldn't be retiring the shares, as well as purchases by vehicles or other affiliates on the platform.
And I think, were you guys planning to repurchase 10% of shares outstanding by year end? And where are you, can you say anything about where you are in that process at this point?
Yeah, so we've publicly announced what we repurchased through our daily buyback program last quarter, which was north of $1 million in equity. This program here is going to be the large tender offer, $9 million. So that should get us to about 8 to 9%, and then we'll turn the buyback program, the daily buyback program, back on hopefully before year end, and that should get us to that 10% threshold. If it's not by 12/31, it would certainly be by the first quarter of the year. The Dutch tender offer, we set it at a range of 5 to 15% premium to the trading price on the day before we open the tender offer. So the minimum tender offer price is $13.63, which yesterday we closed at $12.99, so a premium to where it's currently trading. And to the extent to satisfy that $9 million of demand, the price is increased by 1% up to that 15% premium. We will tender up, let's say we have $2 million of demand at 1363, then we have another $3 million of demand at the next price level, and then we can satisfy the full $9 million at the third level. Anybody who tenders at or below that level will get their tender honored or prorated to the extent there's more demand than the $9 million in the modified Dutch tender offer.
And as long as we're on the topic of capital returns to shareholders, can you talk about the current dividend yield and the structure there?
Yeah, so earlier in the year, we switched to a variable dividend policy where we set our base dividend at about 9.5% of NAV, or 47 cents per share at the time. And then the variable component, or the supplemental component of the quarterly distribution, is set at 50% of the incremental net investment income we generate over the base dividend of 47 cents per share.
Gotcha. And then I guess if we just go ahead.
I was going to say, so the yield is about 14.4%, as I highlighted earlier.
Right. If we kind of turn away from that topic and kind of more towards the industries you look at, what industries do you guys like right now? Are there any that you tend to avoid? How does the macroeconomic conditions play into that? What are your viewpoints there?
Yeah, so in terms of, so we are generalists. However, it's more about industries that we stay away from. So we don't do energy, we don't do commodity deals. We tend to not finance consumer businesses or businesses dependent on consumer demand. We generally stay away from high CapEx businesses. Anything with cyclical cash flows, we tend to avoid. We really like sticky revenue streams, diverse revenue streams, long duration revenue contracts. So the bulk of the portfolio is in technology, healthcare, and business services.
Gotcha. And then I guess I'll ask one more question, and then if anyone from the audience has some, please jump in. If we look ahead for the next 12 to 18 months, what should investors expect from you guys?
Yeah, well, we have an incredibly shareholder-friendly tender offer program and a commitment to repurchase up to 20% of the shares outstanding to the extent we trade below 80% of book. So that should be accretive to investors in and of itself. We're also going to transition to a monthly dividend. By virtue of the largely retail shareholder base we have, we thought there are certain investors that own our stock today that clearly trade off of the dividend announcement. So by virtue of having a monthly distribution, we thought it might stimulate some interest in the stock and support higher volumes and cleaner trading. So I think that's a strong catalyst. We've also got an expense waiver in place for $1.5 million of expenses over the next 2 years. And we spent a long time trying to get the affiliate merger done, so we haven't done an inorganic growth transaction since 2021 prior to the Logan Ridge combination we just completed this summer. We are highly acquisitive, and I'd be surprised if you look at our last 5 to 7 years of growth. I think we'll return to that cadence of exploring inorganic opportunities and creative ways to grow BCP Investment Corporation in the relatively near to short term. 12 to 18 month time frame.
Right. Excellent. Any questions from the audience, please?
We're starting to see an environment where interest rates are starting to lower. also a little bit of uncertainty from the Fed about lowering interest rates. How do you guys, from a forward-looking perspective, see your loan portfolio performing in both environments?
Yeah, so, we're not macroeconomists, so we generally don't, we're not buying duration, we're not underwriting duration. Our liability structure has a natural hedge to floating rates in our investment portfolio, albeit operating earnings will come down marginally. We have our interest rate sensitivity disclosures in our financials. It's about 2 pennies, a quarter of NII for each 50 basis point rate cut that occurs. That said, by virtue of rates coming down, we expect deal flow to pick up. Anytime the M&A environment gets rolling, that generates fee revenues. It's healthy for our portfolio companies. Exits happen sooner. We generate back-end fees and things like that. So overall, I think rates coming down will over time be generally positive for the portfolio. Importantly, though, again, we don't make a call on rates when we underwrite a credit. We do true private equity style diligence. We underwrite the business and the cash flows that the business generates. We're focused on interest coverage ratios, things like that, to make sure they can support the debt. But the broader macroeconomic environment, while indirectly relevant, for any idiosyncratic credit risk we take, that's usually not the primary driver of whether or not we make an investment in that company.
And under your umbrella, do you just have 40 Act funds, and how many do you have non-40 Act vehicles?
Yeah, we definitely do. So we have about $2 billion of insurance assets we manage. Those are in a non-registered format. We've got about a $4 billion institutional platform in traditional private credit drawdown funds. The rest of it is sitting in 40 Act vehicles. So we have two interval funds and then 2 BDCs. Those are our primary buckets of capital.
All right, Brandon. Well, thank you so much for coming. Unless there are any other questions.
All right. Thank you, everybody.
Great having you.
With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple, then ChannelCheck truly is your choice. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Micro-Cap Investor Conference, NobleCon. And here's the best news. Since ChannelCheck is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why ChannelCheck is North America's leading source of research on the companies that just may change the world.